My name is John Patton. I am the owner of Texas Insurance Training Academy, and I am here today to teach you how to pass the limited lines insurance licensing test. Now, guys and gals, this is probably one of the easiest tests that the Department of Insurance has ever put out there. So what I want to stress to you right now is that a couple things. Number one, there's 50 questions on the test. Out of those 50 questions, you need to get 35 of those correct. The majority of the test is going to be over the Texas statutes, laws, things like that. More than anything, it's going to come down to memorizing definitions and doing some word association along the way. I'm not here to try and teach you about insurance today. I just want to make sure that I can get you to pass this exam, get you licensed so you can start making money, right? That's all of our goals here. So anyway, you should all have my study manual that came with this program. You also have access to the exam simulator that I created that has practice questions in it. In the study manual, in the back, I've got a cheat sheet. Once again, definitions, word association are going to be in the back of that study manual. As you can see, the study manual is not very thick. Okay, so this is really kind of a quick lesson for you on what you need to know exactly to pass the test. Okay, don't think you need to know anything else outside of this, but what I teach you, if you focus on it, it will enable you to go in the testing center, have things look and sound familiar to you where you can answer your questions, get out of there with your 70, and voila, you can get licensed. All right, so if you're ready, let's go ahead and get started. So with our limited lines insurance licensing test that we are going to be preparing you for today, first thing I want to do is go over some basics here. First, risk management, key terms and concepts. So once again, terms are very, very important as you're going through learning this. First, we need to know what is risk, okay? And so risk is a very important word here when it comes to your terminology. The term risk and loss can sometimes become confused. From a purely financial perspective, loss, and this is really important, loss can be defined as the state of having less of something than before because something of it has gone. Okay, so loss is having less of something. Okay, in other words, a reduction in the value of something has occurred. The something could be a person's life, health, income, or other assets. Risk, on the other hand, once again, this is why this term is going to be important for you. Risk can be defined as the possibility or uncertainty of a loss occurring. So it's, again, very important that you understand that risk, that word, is defined as the possibility or uncertainty of a loss occurring. So if you can make that your definition of risk, possibility or uncertainty of a loss occurring, now all of a sudden you have a definition. And so no matter how they put risk in your test or wherever you might see it, you have that definition. Does that make sense? So anyway, once again, really want to try and break this down to keep it as simple as possible. So with risk, a loss could happen, but it may not. There's an element of uncertainty or doubt that must exist if something is to be considered a risk. All right, so here you go. For example, and I apologize there, let me get those out of the way. All right, so for example, while driving an automobile, an auto accident could occur. Alternatively, if a person walks across a freshly mopped floor, he or she might slip or fall, causing injury to them. It's uncertain if either one of these incidents would occur, but the possibility does exist. So the possibility does exist. So that gets us right back to our whole definition of what a risk is. Risk can also be used to describe the insured or the exposure that the insurance covers. For example, Joe's Construction Company is the risk covered under the policy, or Joe's Construction Company is covered for a liability of risk. All right. So there are many types of risk. However, in this course, we will focus on two types of financial risk that are relevant to insurance: speculative risk and pure risk. Okay, speculative risk. Everybody has probably gambled at some point of their life. So if you have ever gambled, that is a speculative risk. It offers the chance of loss as well as the opportunity for gain. And if you're like me at all, Most of the time you might have lost. Okay, a few times you win, but most of the time you lost. It's speculative. So gambling, also investing, or made any bad investments, that's speculative. So anything in the stock market often used as examples of speculative risk. With both, you have a choice to risk something for a possible gain. Okay, so now we know what speculative risk is. Now let's contrast that. But first, let me give you an example. So, for example here, Joe enjoys playing cards a few times each week. While playing, he bets a small sum of money on each hand in exchange for the chance of winning a larger sum of money. Joe may win or Joe may lose depending on his poker skills and the cards he has dealt. Playing this game is a win-or-lose situation, a speculative risk. So keep in mind, very important, speculative risks are not insurable. So there is no insurance that you can take out if you're going to go to Vegas and gamble your money. Okay. So once again, when's the last time you ever heard of any insurance company offering poker coverage? Just not going to happen. Now, let's look at a pure risk. A pure risk only offers the possibility of a loss. Okay, it is a pure risk. There's only one thing that could happen. You could lose. There is no opportunity for gain or profit. So, an example of a pure risk would be a fire loss to a person's home. Insurance would pay enough to restore the home back to the way it was before the loss, but no more. Okay, so if my house burns down because of a fire, okay, that's a pure risk. The insurance company is only going to get me back to where I started, where I was before. This concept, and you're going to see this word in a little while, so I want to go ahead and throw it in. I'm going to throw nuggets in along the way, things I really want to make sure that you grasp a hold of. It's called the principle of indemnity. Okay, so the word indemnity or indemnify means to make whole again. So if you have a pure risk, there's no possibility of gain. It's only going to bring you back or restore you to where you were before the loss. So that's what the word indemnity or indemnify means. So once again, very important that you get those. All right, so if the insured owned a 2,000 square foot home before the fire, that is what the insurance company will pay to replace. There is no real gain or profit for the insured. Keep in mind that pure risk are the only types of risk accepted by insurance companies. They will not accept a speculative risk. So now we know what a risk is. Now let's look at some different methods of handling risk. So we know there's a risk out there. What are some of the methods to handle it? Whether it be individuals, businesses, and governments, they're exposed to innumerable types of risk each day. These risks may be financial, physical, political, or another category of loss uncertainty. Many risks are small in nature, do not present substantial financial impact to us. However, losses resulting, for instance, from auto accidents, serious health conditions, or loss of life can have financially devastating effect on our lives. The primary goal of risk management is to minimize or mitigate risk of all times. So this is the goal of risk management, is to minimize or mitigate risk of all types. To that end, a variety of methods or techniques can be employed to help manage the risk. So first, you think of the different risks that are out there in the world or that are out there in our lives. One way to handle risk is avoidance. To avoid a risk, simply do not perform an activity that has any risk. You can completely avoid the risk of being in an automobile accident, for example, by never getting into an automobile. Okay, now for some of us, that's probably not going to happen. Another example is that you could avoid losing value in your retirement portfolio by investing in FDIC-insured certificates of deposit. You're avoiding the riskier investments. So avoiding risk, just doing away with it. Risk retention. Now, whether you know it or not, a lot of times this is how we as human beings handle risk. We retain the risk. Risk retention is choosing to be financially responsible for part or all of the risk. So once again, if you don't have health insurance, you don't have life insurance, you don't have car insurance, that you are retaining the risk. Anything that happens is going to come back on you. This may be a conscious or unconscious decision. An example of a conscious decision to retain risk is when an insured decides to take a higher deductible or higher co-insurance percentage in return for a lower premium. Okay, so when we talk about deductibles, for instance, let's talk about automobile deductibles. Let's just kind of give you an example real quick. So you are talking to your insurance agent, and your agent says you could have a deductible of $250 for an accident, which is the amount that you're responsible for before the insurance company helps out in any way. Or you could have a deductible of $2,500. Now, say which one would you like to have? The amount you're going to be responsible for, the part you're going to retain yourself before the insurance company kicks in. Well, most likely you'd say $250. Well, if you want the $250 deductible, your premium on that is going to be $150 a month on that policy. You're like, whoa, I can't afford that. Well, if we go all the way up to $2,500 a month, guess what? That's going to get your premium down to $30 a month. So the more risk you retain, which means the higher your deductible, the lower your premium. The lower your deductible, the less risk you retain, the higher your premium. And that same concept goes with the co-insurance that they were just talking about. So after you've met your deductible, then there's co-insurance, all right? So co-insurance is a percentage of cost sharing. That's where you get kind of like 80-20, 70-30, 90-10, or 50-50 for instance. So when you're learning about when you're looking at co-insurance, you need to know that the insurer, the insurance company, is going to be the number on the left. You, which would be the insured, you are the number on the right. So after you've met your deductible, the insurance company, let's say it's 80-20, they pick up 80% of your expenses after that, you only have to pick up 20%. Whereas opposed to 50-50, after you've met your deductible, you pick up 50% and they pick up 50%. Which one do you think would have the lowest premium? Hopefully right now you're going right at 50-50, because remember, the more you participate in your sharing of expenses, the less your premium would be. If you would have thought it would have been 90-10, well, that's going to be a whole lot higher premium than it would if it were 50-50. Because after your deductible, the insurance company is going to pick up 90% of all your expenses. You only have to pay 10%. That's going to jack up your premium. So once again, just kind of having an understanding of deductibles and coinsurance and how they affect your premium can be beneficial. All right. And so, once again, another example of risk retention is when a person chooses to fully self-insure rather than purchase insurance. The insured then retains all of the risk, and that was kind of how I started this whole conversation on risk retention. So there may be times when a person forgets to insure an asset or is unaware that insurance exists to cover a particular contingency. As an example, there may be some people who are not aware of long-term care or disability income insurance. In this case, the insured has again retained all of the risk. All right, another way to handle risk is risk sharing. Risk occurs when risk is distributed among several people who have invested a certain amount of money. Losses are allocated to each person based on a simple formula. So for instance, let's say you're going to go into buying a piece of property with a bunch of friends, and the total investment is going to be $500,000. And there are 10 of you. Okay, so if there's 10 of you, that would be $50,000 each for your individual investment, which means 50,000 divided by 500,000 is going to be $10,000. Okay, so you're sharing, you're only responsible, if something happens to that investment property, you're only responsible for 10%. So the more you spread out risk, the better it is. So that's how risk sharing would work. Next way to handle risk is reduction. Okay, since risk cannot be completely avoided, the possibility or severity of the loss can be reduced by using risk control techniques. For example, while home fires are not always preventable, okay, they're going to happen, the chance or severity of a fire can be greatly reduced by installing fire suppression systems. So once again, you install a fire suppression system, fire alarms, you are reducing, that's the chance of having a total loss. Another example is reducing the chance of death by quitting a dangerous hobby such as skydiving. All right? Chances of you dying go down a whole lot if you're not jumping off the side of a cliff every day. All right, another way to handle risk is transfer of risk, which gets us to the real basics now of what insurance is all about. Because insurance is, so right here, insurance is the transfer of risk. That's what insurance is all about. When you purchase any type of insurance policy, you're transferring a portion of the risk to the insurer. The policyholder pays a premium amount much smaller than the value of the insured item or person. In return, the insurance company accepts the financial responsibility for covered losses under the policy. So transferring risk is really the most popular way of handling risk, and that's what insurance in general is all about, is transferring risk. All right, next term that we need to know is a hazard. A hazard is a condition or source that increases the chance of a peril occurring. It could also increase the severity of a peril. Hazards will typically be present before a peril occurs. So that term, peril, is really important for us to know. So real quick, what I want to do is, since this is talking about peril, is I want to go down here a little bit. Maybe. Hold on, let me get back to a mode here. All right. So let's look at a peril real quick, because knowing what a peril is before we talk about a hazard is important. So peril is the cause of a loss. That is a peril. The peril causes the loss. They are what we insure against, very important, when we purchase an insurance policy. Perils are generally listed in an insurance policy as covered perils, meaning that any peril not specifically listed in the insurance policy will not be covered. For instance, with auto insurance, if collision is not listed with a limit of insurance on the policy, then collision is not included on the coverage. With homeowners or commercial property policies, if flood is not specifically listed as a covered peril, then the flood is not included in the coverage. Here are some common examples of perils. First, a fire. House burns down to the ground. The peril is the fire. Accidents. A person runs a red light, hits another car. The collision is the peril. Okay, so up here we had the fire, cause of loss, and here we had the collision, the cause of loss. Explosions. A gas stove explodes in a home. The explosion was the peril in this case. Flood. A river rises above the flood level, floods a home. This means that the flood was the peril. Talk about life insurance. Death. A person dies from heart disease. Then death is the peril. So once again, a peril is the cause of loss. So now that we know that a peril is the cause of the loss, let's go back over here and take a look at a hazard. All right. So once again, a hazard is a condition or source that increases the chance of a peril occurring. Remember, the peril was the cause of the loss. So a hazard is something that is there that increases the chance of that peril occurring. It could also increase the severity of a peril. Hazards will typically be present before a peril occurs, which makes sense. A hazard is going to be there, which increases the chance of that peril happening. So here's some different types of hazards. First, a physical hazard. A physical hazard is a physical source that causes a loss or increases the chance of a loss occurring. Common physical hazards, here you go, these are important. Slippery floors, icy road conditions, and faulty structural defects. Those are all physical hazards because they are increasing the chance of a loss happening. Next type of hazard is a moral hazard. Moral hazards occur as a result of an individual's decision, this is important, to do something wrong or to be less conscious of their actions because they know their insurance coverage will bear the cost of the loss. For example, since Jane has full insurance coverage, okay, she's got liability, she's got collision, she's got it all on her car, she is not concerned about locking her car when it is unoccupied. Her way of thinking is that if the car is stolen, her insurance company will cover the loss. Therefore, Jane is less cautious at the possible expense of her insurance company. So that's a moral, when moral, think of your moral decisions. Okay, that is a moral hazard. Another type of moral hazard occurs when an insured fakes an accident or acts negligently with the intent to collect on an insurance claim. Okay, you don't have the best morals if you are faking an accident or act negligently to collect on an insurance claim. All right, so pretty easy stuff there. Next one, all right, so this next type of hazard is a morale hazard, okay? Very similar to moral, but morale is a person's careless or reckless actions and attitudes may be a hazard if a loss occurs as a result of them. Example, oh, this one might hit home for some of you. Using a cell phone while driving, okay? That is careless, reckless, it's your attitude, and that is a morale hazard. Failing to wear a seatbelt while driving or riding an automobile. Regularly eating pastries after being diagnosed with diabetes, okay? You are making a decision, a careless decision or reckless decision that increases a peril happening. Okay? All right, so you got all of those. We got perils, which we just talked about. So a quick review. Remember that a hazard is a condition or the source that increases the probability or severity of a peril. Hazards typically will be present before the peril occurs. However, remember that it is the peril that actually causes the loss. So for example, here you go, difference between hazards and perils. Storing 50 gallons of gasoline in your attached garage is a hazard because it will increase the probability of a fire or a peril and would certainly intensify the fire that started in a completely separate part of your home. Melting ice on the floor of the frozen food section of a grocery store greatly increases the possibility of a slip and fall injury. Okay, so that melting ice is the hazard which could cause the peril to slip and fall. Okay, so we got those definitions. Now let's look at loss. Financial loss occurs when the subject of insurance, person or property, suffers damage or destruction by perils insured against under an insurance policy. Losses can be total or partial and are stated as a dollar amount in a policy. So here's a property loss example. The insurance adjuster determined that Joe had a covered partial loss in the amount of $34,000 after an accidental fire damaged his home. Okay, so it wasn't a total loss, it was just a partial loss up to a certain dollar amount. Liability insurance example, the insurance company paid Joe's neighbor, Tom, $25,000 for injuries he sustained from the fire while at Joe's house. So Joe's insurance company, and Joe sharing the risk, were liable for that injury that he sustained. Okay, so what is a direct loss? Some property insurance policies cover only direct losses, some cover only indirect losses, and some cover both. This is a direct physical loss that occurs to your property by a covered peril, such as a fire damaging your home or an auto collision involving your covered auto. An indirect loss. So indirect or consequential loss is the result of a direct loss. For example, if your home is damaged by fire, okay, had a fire, and it is deemed unsafe to occupy, okay, so it was bad enough, things got destroyed, you can't live there, then you may need money to pay for a temporary place to live while repairs are being made. In this situation, the damage as a result of the fire is the direct loss, while the temporary housing is the indirect loss. Okay, fire, damage to the house, direct loss, but you have to have some temporary housing is an indirect loss. And so very important, as you can see in your study manual, and the study manual I have up here, which is the same as yours, everything that is highlighted along the way is important for you to make sure that you understand where it goes on your test. So once again, indirect loss, that's the temporary housing, would be the indirect loss. Loss settlement. Loss settlement or valuation is how losses will be paid. In general, the insured can collect the lesser of, okay, so once again, not more than, because remember, the principle of indemnity, they can collect the lesser of the insurable interest, the policy limits, actual cash value, cost of repair, or replacement cost. So what options do you have when buying a property policy? All right, option number one, actual cash value, ACV. ACV is defined as today's replacement cost minus depreciation on the insured item. Today's replacement cost, what does it cost to replace it today, minus the depreciation. So replacement cost minus depreciation equals your actual cash value. So here's an example. You got Rhonda, she has a large screen TV that was destroyed in a fire. The TV depreciated $300 in the first year, $150 in the second, $150 each year remaining 3 years. After the TV was destroyed, Rhonda located a new TV that would cost $2,800. The actual cash value of Rhonda's old TV is $1,900. So she's replacing, she's got a new one, $2,800. Okay? So you take today's replacement cost minus each year of depreciation equals $1,900 is the actual cash value. So that's how much that she would get reimbursed, is the actual cash value. All right, option two, replacement cost. The insurer agrees to automatically replace cost for covered losses without subtracting depreciation. Initially, the insurer will pay only the actual cash value of the covered item to be replaced. Once the item has been replaced, the insurer will pay the remaining balance. All right, so that's just $2,800. They're going to pay the $1,900. Go back to Rhonda's TV, pay the $1,900 now, and then they'll pay after it's been replaced, they'll pay the remaining balance. Option three, functional replacement cost. The functional replacement cost is when the damaged property is repaired or replaced with lower cost alternative materials that are functionally equivalent to the damaged materials. This allows replacement of expensive and outdated items with less expensive, more modern and up-to-date work. An example would be if you own an older home with lath and plaster walls. After a fire, the insurer replaced the walls using more modern materials such as wallboard or plyboard. So that's functionally, in this day and age, wallboard or plyboard is going to be better than lath or plaster. All right, option four, agreed value. This is a property policy provision where the insurer and the insured agree at policy inception as to the amount of insurance that represents a fair value for the property. These contracts are often used to help determine the value of certain hard-to-value items such as paintings or antiques. So make sure, go ahead and circle or highlight paintings and antiques and make sure you associate that with agreed value. Okay, so once again, you associate agreed value with paintings or antiques, and that will help you to answer a question on the test. Next option, option 5, is a stated value. If stated value coverage is selected, the maximum amount paid at the time of loss is the value of the policy, even if the loss amount is larger than the amount insured. The insurer's obligation is the cost to repair, replace, or cash out their insured at their discretion, not to exceed the stated amount or maximum coverage. Next, option 6, fair market value. Market value would be what the property could be sold for at the time of loss. For example, suppose Joe spends $400,000 to build a fancy house in an open area. Subsequently, the land around the house becomes zoned for heavy industry, and a bad-smelling oil refinery is built nearby. Poor Joe. Joe may have trouble finding a buyer, therefore his house may have a market value of only $250,000, even though it would cost $400,000 to rebuild if it were destroyed. Okay? So you always hope that your real estate goes up and doesn't go down like poor old Joe. Okay, next, you've got deductibles and binders. While the agent is discussing coverage details with the applicant, various deductible amounts will be presented to the applicant. And I just gave you examples of those earlier. The higher the deductible, the lower the premium. A deductible is the portion of covered loss that is not, this is important, it is not paid by the insurance company. That's the portion that the insured has to pay on their own before there is any cost sharing with the insurance company. So therefore, the insured is responsible for any deductible amount at the time of loss. The insurance company will pay the remaining portion of any covered loss up to the policy limits, because every policy has limits to it. Deductibles, and here's a couple things you really need to give out deductibles. Deductibles help minimize frequent claims, because if you have a high deductible, you're probably not going to file it. You'll be probably not filing a claim all the time. And deductibles help eliminate small claims. Kind of the same thing there. You got a small claim, like I'll just take care of it myself. It doesn't even meet my deductible. That's what deductibles. It helps from overutilization of a policy. By having a $250, $500, even $1,000 deductible or higher, an insured will not usually report any claims up to the deductible amount. So after completing an application for insurance, the agent should issue a binder to the applicant. And here's what you need to know as far as a definition for a binder. A binder is an oral or written agreement that provides temporary evidence of insurance. Okay, so it is a temporary evidence of insurance until a policy can be issued. Note, a binder does not, very important, it does not guarantee that a policy will be issued. Okay, but it could provide temporary evidence of insurance. It only provides that temporary coverage while the application is underwritten at the home office. No binder can be valid beyond the issue date of the policy. So once a policy gets issued, the binder is no longer good, or beyond its effective date, whichever period is shorter. So once again, make sure on a binder that you know it is an oral or written agreement, provides temporary evidence of insurance. That is what a binder is. I hope that you can see as we go through here, don't overcomplicate this. Know some bulleted definitions and you can start making sense of everything else. We only have 50 questions on this test. I know that you're going to do great on it. All right, here is your principle of indemnity. And remember, the word indemnity or indemnify means to make whole again. associate the word restore with indemnity as it relates to a covered loss. The principle of indemnity states that the insurance company will restore you to the same financial position you were in before the loss occurred, no better, no worse. Okay, remember, makes whole again, brings you back to where you were before. To indemnify means to secure against loss and make whole after a loss occurs. However, you should not be compensated by the insurance company in an amount exceeding your economic loss. There should be no gain from your loss, only restoration and not a profit. And if you can remember what type of risk that is, right? So no gain from your loss. Remember, what was that word? Everybody got it? Yep, I bet you do. Speculative risk. Speculative risk. Remember, on speculative risk was actually your gambling. So speculative risk was gambling. No, because there could be a gain or a loss. Now, if there should be no gain from your loss, only restore you to where you were before, then it has to be a pure risk. Okay, so speculative is gambling, a pure risk, no gain from your loss. Without this principle, the fundamental purpose of insurance could be challenged by persons purposely causing losses to profit from insurance. So indemnity, no gain in the claim. All right, more terminology for you. Limits of liability. These limits are stated in the policy and represent the maximum amount that the insurer will pay toward a covered loss. Limits can be stated as either split limits or combined single limits. But just know limits of liability, the maximum amount that the insurer will pay for a covered loss. Next term is extensions of coverage. In addition to the limits stated in an insurance policy, the policy may have a coverage extension section and additional coverage section. The coverage extensions provides added, this is important, added and expanded coverages for the item insured under certain conditions. All right, so here's an example for an extension of coverage. For example, a coverage extension called transportation expenses may be available under a personal auto policy. It extends coverage to a non-owned car or trailer, which takes the place of a covered auto that's inoperable because of theft, breakdown, or destruction. The replacement vehicle is covered as a temporary substitute auto. So it's not like it's already listed on the policy. It is an extension of your current coverage. All right, subrogation. Subrogation, this term, definition that you need to know. Most policies come with a subrogation clause, so that if another party is legally responsible for the damages, the insurer will pay you, so they're going to take care of you. Let's say you got in a car wreck. Your insurance company takes care of you, and then sue the negligent party to recover the damages, money they've already paid out to you. The insurance company will not pay you and also allow you to recover damages from the negligent party for the same loss. So you, as the insured, are not allowed to collect twice through subrogation. For example, Joe's injured in an auto accident caused by another driver. The other driver refuses to pay for the damages. So Joe's insurance company intervenes and pays for the damages. His insurer then sues the other driver and the driver's insurance company to recover amounts paid on his behalf. So subrogation just allows him to collect from a third party who caused a loss. Okay? Subrogation, they can collect from a third party who caused a loss. Through subrogation, the insured is not allowed to collect twice. All right, now we need to define an accident. Most definitions of an accident have similar wordings as an unplanned, uncontrolled event leads to or may have led to the injury to people or damage to property. That's an accident. Unplanned, uncontrolled, leads to injury to people or property. That's what an accident is. All right. The Fair Credit Reporting Act. Fair Credit Reporting Act is federal legislation. It is one act contained in the Federal Consumer Credit Protection Act, along with the Truth in Lending Act and Fair Debt Collection Practices. It is designed to promote accuracy and ensure the privacy of information used in consumer reports. Consumer reports, think credit reports. Okay, a credit report is a type of consumer report. All consumer reports are subject to the Fair Credit Reporting Act. So it established procedures that these reporting agencies must follow to ensure that your records are confidential, accurate, relevant, properly used. And it also protects you, the consumer, against the circulation of inaccurate or obsolete information. That's why things have to fall off your credit report after a certain number of years, 5, 7, 10. Some things are actually 14 years they could stay on there. But that's all because of the Fair Credit Reporting Act. So a credit report is usually a written report from a consumer reporting agency that shows a consumer's creditworthiness, credit standing, credit capacity for the purpose of determining eligibility for insurance coverage. Now, consumer rights. Consumers have the right to dispute information in their files if they believe it is inaccurate or incomplete. Once again, that's what the Fair Credit Reporting Act does. Credit reporting agencies may be required to reinvestigate and correct or delete outdated or inaccurate information. Once again. All right. Next, we have a notice to the applicant must be issued to all applicants for insurance coverage. All right, so this notice to applicant issued to all applicants. So any applicant has to get a notice to applicant. This notice informs the applicant that a report will be ordered concerning their past credit history and any other insurance for which they have formerly applied. The agent must leave the notice with the applicant along with the receipt. Once again, it's just stating the insurer's practice regarding the collection of personal information. They just need to know that the insurance company is collecting their information, then how they can use it, usually for underwriting purposes only. And penalties, violation of the Fair Credit Reporting Act. And this is for your reporting agencies, the credit reporting agencies like Experian, Equifax. Violators of the Fair Credit Reporting Act may be subject to fines and imprisonment and may be required to pay an actual damages suffered by a consumer, punitive damages awarded by a court, and reasonable attorney fees. The maximum penalty for obtaining consumer information reports under false pretenses is $5,000. Imprisonment for a year or both. Okay. Okay, now let us look at some different types of authority that an agent could have. There's two types that we're going to talk about: implied and apparent. So implied authority is authority that you are assumed to have but is not expressly granted in your agent contract. Implied authority is secondary to express authority because not every detail can be written in an agent's agreement. So let's talk about this real quick. This term, express authority, when you get contracted with an insurance company, there's going to be a contract between you and the insurance company. That contract contains the express authority. That's what's written in the agency contract between you and the insurance company. So that term, express authority, is what's written in your contract. Implied is the authority that you're assumed to have, but it's not expressly granted in your contract. For example, the agency agreement may not specifically authorize you to have customers pay their premiums at your office. So once again, paying premiums at your office is a form of implied authority. Okay, so I need you to associate implied authority with some customers paying their premium at your office. If you allow this regularly and the insurer accepts the premiums, your authority to do so is implied. Once again, it's not written in your agency contract. It's just implied that you can do that, take the premiums. Now, apparent authority is a little different. So on apparent authority, let's get my view here for you. On apparent authority is the perception by a third party that you have been given the authority by the insurer to transact insurance business on behalf of the insurer. There is the appearance of an agency relationship. Under the law of agency, the principal, which is the insurance company, so that term principal means the insurance company, is liable for acts of the agent. You as an agent represent the insurance company. They're responsible for your actions. So on your apparent authority, so if a person who is not an agent appears to a customer to have been given authority by the principal, then the principal is responsible for the acts of the person they allow to appear to have that authority. For example, if you have an insurers, and here's the examples that you need to know, any brochures, letterhead, applications, or marketing materials on you or in your office. Okay? A reasonable assumption is that you have the authority to transact business of insurance on behalf of the insurer. It's apparent to the public that you have the authority to conduct the business of insurance, even if you have no valid contract with the insurer. So let's take a look at that real quick, just once again, because I want to make sure that you separate these two types of authority. Remember, implied authority, and this is kind of how you're going to see it on your test, letting customers pay their premiums at your office. That is implied authority. However, apparent authority is brochures, business cards, marketing materials, applications. Okay, that is apparent authority. Okay, make sure you separate those two. All right, policy provisions. Declarations, schedule of benefits. Each declarations page contains the same type of information, but is customized for each policy, providing a summary listing as follows. So a dec page or declarations page, first page, it's going to spell out who's covered, what's covered, how much is covered, and then maybe what's not covered. Okay, so first, who is the insured? So there is a named insured. That's the person or business that is insured under that policy. There may be a first named insured. So if there's more than one named insured, this is the person who has the most responsibility and rights in that policy. Additionally named insured, this may be the bank that has the property finance, so like a third party that is going to be involved in this whole transaction. So you get, for instance, you get a loan from a bank, you owe the bank money, you have to have insurance on your house. Insurance company says, okay, John, your house is going to be the property that's insured. Additional named insured is going to be your finance company or bank. That way, if something happens to the house, myself and the bank both have to be notified. For instance, I just had my roof replaced. Insurance company said, okay, John, we're going to send you a check. This first check we're going to send to you, but it's going to have your name on it, and it's going to have your mortgage company's name on it. They have to sign off on that. So they were the additional named insured because they're a part of, since I owe them money, they have to be a part of anything that happens to my house. Okay, so that's how the additional named insured would come up. What property is covered and where it is located. Specific insurance, this is when you insure a specific item. But then there's blanket insurance. So this is when you insure several items, such as all personal property located at 123 Main Street, wherever my house is located. Everything, all my belongings inside, have a blanket policy on everything, all my belongings. But if I wanted to insure something specifically in that house, it would be specific insurance over that item. Whether it be like my wife's diamond ring, whether it be a computer, okay, those might be specific insurance. Specifies the policy period, date, when coverage begins, ends, and time, where and what time zone. Next, what's on the declaration page? How much the property is insured for. Policy limits. This is the maximum. This is important, the maximum amount for which an insured is protected under the terms of the policy. So every insurance policy is going to have the policy limits. How much, what's the maximum amount they're going to pay? It gets you back to your principle of indemnity again. Premium amount, how much is it costing you? Policy period and coverage territory. Each contract will define the policy period, which is usually 6 months or 1 year. The contract will also define the coverage territory. For example, your homeowner's policy will cover your personal property anywhere in the world up to a certain limit. A commercial property policy will cover business personal property on premises or within 100 feet of the premises. All right, next, we have the insuring agreement or insuring clause. It contains the insurer's promise to pay. This is important, by the way, guys. Make sure you get this. Insurer's promise to pay is included in the insuring agreement. It also contains an explanation of what property is covered and the perils insured against. Okay, so the insuring agreement itself has a lot of information in it, such as key policy coverages are described in detail, additional coverages, if any, are described, and then lists the specific perils insured against, such as fire, lightning, flood, hail. Okay, all that is going to be in the insuring agreement. So the insuring agreement is a very important part. How I've seen it on your test when I have taken the test is contains the insurer's promising to pay. That is in the insuring agreement. Conditions. The conditions section of an insurance policy shows the general duties or procedures that the insurer and the insured agree to follow under the terms of the policy. Provisions are used in the policy that stipulate the conditions or place limitations on the insurer's promise to pay or perform. If the policy conditions are not met, the insurer can deny the claim. All right, so this is important on the conditions piece, because I've seen a test question over conditions. It shows the general duties or procedures that the insurer and the insured agreed to follow. So both the insurer and the insured agree to follow. So certain conditions have to be met, like I have to pay my premium if I expect them to pay for that loss, right? Those are conditions that have to be met. If I don't pay my premium, if that condition is not met, then they can deny the claim. Or, for instance, if I was negligent and I burned my house down because of arson, for instance. Well, I didn't meet all the conditions in the policy, they can deny the claim. So once again, the conditions section is an important piece for you. All right, get back over here. Common conditions in a policy include the requirement to file proof of loss. Once again, so my house burns down. I have to file with them the proof of loss to protect the property after loss and to cooperate during the company's investigation or defense of a liability lawsuit. So one of the conditions after filing proof of loss, after loss, is to cooperate during the company's investigation, okay, or defense of a liability lawsuit. Exclusions. This part of the policy eliminates coverage for certain perils. Remember, the peril was the cause of the loss. There are 4 broad categories of exclusions. First, there are non-accidental losses. These losses are excluded because they are certainties, not risks. Wear and tear, deterioration, rust, decay, mechanical or electrical breakdown are all examples of non-accidental losses. The company will not pay to replace your 20-year-old roof just because you think it's time to get a new one. Ain't going to happen. All right? That is. Now, if you have hail, like mine was damaged because of hail, and we could prove that, then they replaced it. Other exclusions. Losses you can control. There are losses you could control or prevent with extra care or effort, such as scratching, breaking, or chipping of valuable objects. All right, so if I have an antique, I have a vase, it's spend a lot of money on it. I could insure it. But if it just gets scratched or chipped, they're not going to cover it. Now, if it gets stolen, they would cover it. All right? But losses that you can control, they're not going to cover. Extra hazardous perils. An example of an extra hazardous peril would be like an earthquake or a nuclear explosion. Most insurance companies are not going to cover those types of things. And then other exclusions, catastrophic losses. This type of loss could bankrupt the insurance company. Losses resulting from war, and once again, kind of gets back to nuclear disasters, are examples of catastrophic losses. That is just way more than an insurance company is going to take on. Limitations are similar to exclusions, but are not the same thing. Limitations eliminate or reduce coverage only under certain circumstances. So, for instance, after a building has been vacant for 60 days, some policies will limit losses by reducing any claim by 15%. Okay, so it's not excluded, it's just going to limit it after a certain amount of time. All right, definition of the insured. It's important to know who is insured under a policy. The person or entity that is listed first on the declarations page is referred to as the first named insured, and we just saw that a minute ago. First named insured is the primary insured and holds the highest rank among all insureds. Okay, so the first named insured holds the highest rank. Make sure you remember that. And has broader rights and obligations under the contract than any other insured. Example of additional rights of the first named insured are the right to cancel the policy, the right to initiate policy changes, and receipt of any return of premiums if you do cancel a policy. So the first named insured has all the rights and privileges in a policy. They're the most important one. All right, let's say you suffered a loss. There are duties of the insured after a loss happens, and this will be on your test, so it'll be very important that you know that. The insured's duties following a loss include giving prompt notice of claim to the insurance company or agent, so you have to notify them promptly if something has happened. Next, protecting a property from further damage. Next, completing a detailed proof of loss, which means an inventory of the damages. Making the property available for inspection by the company. Submitting to examination under oath if required, and assisting the insured if required during the claim investigation procedure. Okay, so all of those are duties of the insured after a loss. So you may have a test question that says all of these are duties of the insured after a loss except. You really have to watch out for those except questions when they come up. This is why it's really important that you use test-taking skills. Don't just kind of run through it. So as a good test taker, here's some things that I really need to make sure that you know when it comes to taking your test. Because human error is really the reason that causes most people to fail a test. It isn't because they don't know the information, but it's because human error got in the way. So what I always say in my test taking is we all, when we're taking a test, we have to learn how to stop. We have to learn how to slow down. We have to learn how to read every word. Because remember, that word except at the end can be very important. And we have to know what our question is really asking. That is the basis of your test-taking skills. Stop, slow down, read every word, and know what your question's asking. Because remember, if you don't know what your question's asking, kind of hard to answer it, right? Now, it is all multiple choice on the 50 questions that you have on this test. You get a laminated sheet of paper when you go in the testing center. I want you to write, stop, slow down, read every word, know what your question is asking at the top. Then here's the next thing you do, and this is the best test-taking tip I can give you. I should charge you double, but I'm not going to. Here you go. On the side, write A, B, C, and D. This will cause you, if you use it, to be methodical. Okay, I don't want you to think too much, all right? It's either you know it or you don't. But I want you to read every word. I want you to read every answer one at a time. And I want you to ask yourself, is this answer true or false? Is this true or false? And if you'll go through, go, okay, yeah, I think that one's true. I think that one's false. This one I don't know. And I think that this one is true. If all of a sudden you do that and you see that you have two true answers, and you're like, wait a second, how do I have two true answers? And you go back and you read your question again, and you see a word at the end called except. All of a sudden, instead of you looking for a true answer, you should have been looking for a false answer. But see, that's how you can minimize human error. Because you miss that word except, all of a sudden you're like, oh, okay, yeah, I'm going to pick A because I know it's true. Well, guess what? You didn't really need to find the true one, did you? You needed to find the false one. This helps minimize that human error that happens to all of us when we're in a testing center. So use this, and I promise you, things will start making more sense to you. You will start minimizing human error, and you can walk out of there with a passing grade. It's that simple. That right there is the basis of what I teach day in and day out to my classes. All right. So, next thing we have here is on your proof of loss. Okay, so you got to provide them proof of loss. Common conditions in a policy include the requirement to file a proof of loss with the company to protect the property after loss and cooperate during the company's investigation. The insured, most insurance policies contain a proof of loss provision which requires the insured to submit a sworn proof of loss. The insurance company is required to pay a covered loss within 91 days. All right, so here is a number that you need to know. And you just need to associate proof of loss with 91 days. How easy is that question going to be if it comes up? You read your question, how many days the insured have to provide proof of loss or pay a covered loss. The insurer have to pay a covered loss. You're like, hey, wait a minute. I remember 91 days. Voila, you can pick it, and you've answered that question just because you've associated these together. Really great if you can do it that way. Okay, next you have arbitration. Now, arbitration is the insurance company and the insured disagree. Okay, you can't come to an understanding on whether the insured is legally entitled to recover damages or to the amount of damages which are recoverable. Then the matter may be arbitrated. Both parties must agree to the arbitration. Okay, so both parties have to agree to it. That's the first thing. If so agreed, each party will select an arbitrator. The two arbitrators will select a third party. If they cannot agree within 30 days, either may take the matter to court. So each party will pay the expenses it incurs, so you got to pay your own expenses, and bear the expenses of the third arbitrator equally. So you got to share in that third arbitrator equally. So if you can't come to an understanding, arbitration is the way to handle it. All right. So now, that's kind of your general terms that you need to know on the general section of your exam. Now we're going to go to Texas insurance regulation.